Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamowen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into the pressing issue of rising mortgage costs and how they're affecting Canadian homeowners. Sandy, it seems like the Canada Mortgage and Housing Corporation is sounding the alarm on this one.
That's right, Steve. According to a report by Leslie Kennedy, the Canada Mortgage and Housing Corporation is closely monitoring the situation as higher interest rates are pushing monthly payments higher, which could put many Canadians at risk when they renew their loans this year and next.
Aled Abiorworth, the Deputy Chief Economist with the Canada Mortgage and Housing Corporation, mentioned that delinquencies and arrears are expected to trend upwards. This could put a downward pressure on the economy as households adjust to these higher costs.
It's a tough situation for many Canadians. Even though mortgage delinquencies remain low by historical standards, they're on the rise. In 2022, the delinquency rate was at 0.14%, but it has risen to 0.22% in the second quarter of 2025. Although this is still below the 0.38% high we saw in 2012, it's definitely a concerning trend.
And it's not just about the numbers, Sandy. Higher rates are affecting home budgets across Canada, especially for those who bought homes during the pandemic when interest rates were exceptionally low. We're talking about 2 million mortgages coming up for renewal this year and in 2026, with the majority being 5-year fixed-rate mortgages.
Exactly, Steve. The economic slowdown means companies are investing and hiring less, which adds to the financial strain for some homeowners. Aled Abiorworth also highlighted the potential impact on housing supply, as builders might become hesitant to start new projects, potentially driving up home prices in the future.
However, it's important to note that TD Bank economist Maria Solovieva offered a slightly different perspective. She pointed out that overall mortgage payments have been declining due to lower interest rates on some loans, with mortgage interest payments falling by an average of 1.7% in the last 2 quarters of 2024.
It's interesting to see the different viewpoints. But one area of particular concern is condo owners in Toronto who bought during the 2020 to 2021 pandemic. They often took 5-year terms and now face much higher payments on renewal, compounded by high local unemployment.
And it's not just Toronto. Other major cities like Vancouver and Montreal will also face similar pressures, though perhaps to a lesser extent. Provinces with stronger economies, like Alberta, might have more capacity to absorb these delinquencies.
For homeowners approaching mortgage renewal, experts suggest reviewing finances early, comparing rates from multiple lenders, and considering ways to reduce overall debt. Options like refinancing, extending amortization periods, or speaking with a financial advisor might be necessary to avoid missed payments.
That's crucial advice, Sandy. Understanding the local housing market and interest rate trends can help Canadians navigate renewals with fewer surprises. Awareness and preparation are key to staying on top of payments as rates shift.
So, Steve, let's dive into the latest from the Office of the Superintendent of Financial Institutions, or OSFI, as they've flagged new risks in their fall outlook. It seems that tariffs and housing strains are the new additions to their watch list for Canadian lenders.
Right, Sandy. OSFI has updated its annual risk outlook to reflect these emerging threats. While their core risks like integrity and security, wholesale credit, funding and liquidity, and real estate secured lending remain, they're now emphasizing the additional risks associated with tariffs and housing market strains.
It's interesting to see how these economic conditions are evolving. OSFI pointed out that the uncertainty surrounding tariff negotiations has led to a reduction in activity among lenders, borrowers, consumers, and suppliers. This uncertainty is affecting confidence and investment, which in turn could lead to reduced cash flows and weaker asset valuations.
And that's not all. The housing market, especially the condo segment in the Greater Toronto and Greater Vancouver areas, is under additional pressure due to these softening economic conditions. OSFI warns that further declines in condo prices could negatively impact investor mortgages and drive down collateral values.
It's a challenging scenario, especially for those invested in the condo market. Robert Hogue, the assistant chief economist at RBC, notes that the fall housing market in Canada shows mixed trends. Buyers are gaining leverage in Toronto, there's a tight supply in Montreal, and Vancouver continues to face affordability hurdles.
Indeed, and OSFI also highlighted that household credit delinquencies are on the rise, particularly among variable rate fixed payment mortgages and self-employed or investor portfolios. Toronto, in particular, is experiencing higher delinquency levels compared to other major centers.
Despite these challenges, OSFI believes that Canadian financial institutions are well positioned to navigate this risk environment. Superintendent Peter Routledge emphasized the strategic advantage of the resilience built into Canada's financial system over the past 15 years, which can support growth in the economy.
That's an important point, Sandy. OSFI's response includes ongoing scrutiny of underwriting standards, portfolio management, and adherence to new loan-to-income measures. They're also monitoring liquidity management and consulting on further guideline updates through 2026.
Let's shift our focus to the Bank of Canada's interest rate decisions. According to Scotiabank's Derek Holt, a rate hold by the Bank of Canada later this month is now more probable, but a rate cut is still possible. The central bank's decision on October 29th is still up in the air as policymakers consider a surprisingly strong September jobs report against ongoing economic challenges.
It seems like the Bank of Canada is in a bit of a bind, Sandy. On one hand, the economy is showing signs of weakness and building spare capacity, which could push them to cut rates. On the other hand, the labor market is defying expectations with 60,400 jobs added in September, which complicates the decision.
Absolutely, Steve. The September jobs report was quite surprising. Statistics Canada reported that most of the employment gains were in payroll jobs, with the public sector adding 31,000 positions and the private sector 22,000. Self-employment also saw a slight increase with 8,000 new roles.
And it's interesting to note that manufacturing made a significant contribution with 28,000 new jobs. Healthcare, social assistance, and other services also saw gains. But we did see a decline in the retail and wholesale sectors, which might indicate some underlying issues in consumer spending.
That's a good point, Steve. While the job market is strong, wage growth has slowed for the second consecutive month, rising only 2.5% on a seasonally adjusted annualized basis. Derek Holt pointed out that collective bargaining exercises are still skewed towards above-inflation wage gains, suggesting potential upward pressure on wages in the future.
Yes, and it's also worth noting that all the net job growth was in full-time positions, with 106,000 new full-time jobs, while part-time jobs saw a decline of 46,000. Alberta, in particular, led the provinces with a substantial 43,000 job gain, followed by British Columbia with 8,000 new jobs.
Ontario and Alberta were the driving forces behind the manufacturing gains. Alberta also saw strong growth in construction, professional and technical services, education, public administration, and healthcare. However, Holt did express some concerns about the reliability of the data, citing an unusually light month-over-month unadjusted drop.
That's right, Sandy. Holt questioned whether changes in seasonal hiring patterns since the pandemic are being properly controlled. If last year's seasonal adjustment factor had been used, the job gains would have been closer to 20,000, which is much lower than the reported figure of 60,400.
It's definitely something to keep an eye on. As we await the Consumer Price Index on October 21st and the Bank of Canada's quarterly surveys, the central bank has some difficult decisions to make. Balancing a strong labor market with economic weaknesses is no easy task.
No doubt about it, Sandy. As always, the Bank of Canada will need to weigh these factors carefully to decide on the best path forward. Whether they hold or cut rates, it will have significant implications for homeowners and the broader economy.
Now, Steve, let's turn our attention to the intriguing concept of postal banking. Ana Pereira recently explored this topic, highlighting the ongoing debate about whether Canada Post should enter the banking business. It's an idea that's been gaining traction, especially amid the current labor dispute between Canada Post and the Canadian Union of Postal Workers.
That's right, Sandy. The idea of postal banking isn't entirely new. With Canada Post reporting significant financial losses, some advocates believe that offering financial services could be a viable solution. The Canadian Union of Postal Workers argues that postal banking could be a lifeline for the Crown Corporation, providing much-needed revenue while offering financial services to underserved communities.
It's interesting to note that postal banking is already in place in several countries like France and Switzerland. These countries have successfully integrated banking services into their postal operations with significant profits. For instance, La Banque Postale in France has been quite successful, serving millions of customers and generating substantial revenue.
However, there are skeptics, Sandy. Some, like Ian Lee from Carleton University, argue that entering the banking sector would be a costly endeavor for Canada Post. He points out that the Canadian banking industry is highly competitive, dominated by the big six banks, and not easy to penetrate.
That's a valid point, Steve. The Canadian banking landscape is indeed dominated by major players. Yet advocates like Simon Enoch from the Canadian Centre for Policy Alternatives believe that Canada Post's existing infrastructure could make it well suited for providing banking services, particularly in remote areas where traditional banks have less presence.
And there's also the matter of regulatory challenges. According to a report by the Industrial Inquiry Commission, Canada Post should focus on fixing its core delivery services instead of branching into new services like banking, especially given the financial strain it's under.
True, but the potential benefits can't be ignored. Postal banking could offer a public option in a market that's often criticized for being an oligopoly. It could also provide essential services to rural and remote communities, which often lack access to banking facilities.
It's a complex issue, Sandy. While the potential for new revenue streams is appealing, the risks and challenges are significant. Canada Post would need to carefully weigh these factors before making any decisions.
Absolutely, Steve. It's a decision that would require thorough consideration of both the opportunities and the obstacles. As we wrap up today's episode, it's clear that the idea of postal banking is a multifaceted one with potential implications for the financial and postal sectors in Canada.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.